See that one? So when the smart money decided to buy into the smart money turning here, that was my exit price there. Managed to bag my 10 ticks, right? So it's really easy to see it if you tie the pieces together. If you tie the jigsaw puzzle together, guys, this is an absolute walk in the park. You can see where every trade is coming from and going to. You can make decisions at certain points. You can figure out what you want to do across all the various other things. And when a bid came in here, where did the offer pull to? So when this bid came in there, where did the offer pull to? Well, we know that answer as well. And we're consistent with that answer. Where did the bid push the offer to? Well, the offer is obviously going to pull either to 76 evens or to 76.20, isn't it? So when this volume came in here, of course, you're going to pull it up to 76.20s. So that's where you should be looking at for your next offer opportunity. It's really, really, really easy to see this, guys. It should really cause nobody any trouble to recognize it. Should be really, really straightforward as a narrative. If they all agree, you press. If they don't all agree, you rotate. And that's all we're doing just now. This all agreed, so we pressed. This doesn't agree, so it rotates back to fair value. It's just an inside rotation, guys. It's not bullish. It's not even close to bullish. It's just another rotation again, isn't it? And this happens in balance areas like this. You know, we can see the shapes, we can see the forms, we can see the patterns, we can see the narratives. But the idea is that is it going to extend the box or is it going to rotate the box? This is not bullish. I've just told you it's not bullish. And there it goes. There it's just rotated again back towards that bid price. It's kind of obvious, isn't it? It's kind of obvious. We said it was either going to come off 76 evens or it was going to come off 76.20. With a buy that came in here, you know, it'd have been a good idea to pull your offers back up to 20s. So obviously when it started to get jammed up in here and it came back below 76 evens, you know that that's going to pull away that bid price and you're going to go back down to this bid price again here. Because that means an offer came in at 76. Well, that means that buyer that came in here at 75.90 isn't going to be there anymore. You're going to pull away that buyer and you're going to go back down to 75 again. Whether it results in you being able to get a trade isn't what's important, because that doesn't always result in a trade in the marketplace. If you're in the floor of the exchange, just because you can see what is happening doesn't mean you're getting a trade done. Because you're maybe not getting the price you want to get the trade done. You're maybe not getting the trade that you're looking for in terms of price. So just because you see what you're looking for doesn't result in trading. What results in trading is getting the price that then makes sense to you at the level, at the narrative, with the storyline that then makes sense. And that's why we talked about linear regression lines. How could you possibly be bullish there when the linear regression line on the crack spread is bearish? Because you're taking a short-term view of the markets. You understand? So if you've got a short-term view of the markets with two going up and one going down, this is perfectly valid to rotate back to the buy side, but it's not valid to buy at higher prices, is it? Why is it not valid to buy at higher prices? Why is it not valid to buy at higher prices? Because that there is going to bring in a commercial seller at higher prices, right? That's going to bring in sellers at higher prices, agreed? Whereas that is going to bring in buyers at lower prices. So we don't have that confluence to turn the market into a straightforward, straight driving price. We can sell at higher prices and we can buy at lower prices. That's what it's telling us. So there you go. There's your strategy. Sell at higher prices, buy on dips. Sell on rallies, buy on dips. In other words, what are we telling you to do? We're telling you that you're in a rotational market just now. So trade it as such. Trade those rotations. Trade the pullbacks. Trade the bottom edges. Trade the top edge ideas. Start thinking about your market as that channeled rotation. And if they all start to stack up together, If they all start to stack up together, change your mind. We've got 2 bulls, 1 bear. 2 bulls and a bear. So it's slightly more bullish than it is bearish. Slightly more bullish than it is bearish. What did we tell you about the NASDAQ today, guys? What did I tell you? What did I tell you about the NASDAQ's open? Anybody listening to what I said? I said we were getting a bear flattener and to be very, very, very careful. Four likes, unbelievable. 4 likes for a trade that's just gone for $1,000. NASDAQ, still care, just ahead of the cash open at 20 past 2. Still care, bear belly flattener. Or a bear deer flattener. I don't know what a deer flattener is. It's probably a big truck that's just hit a poor soul on the highway, isn't it? It's still visible. It's still visible. And because it's still visible, we know that that's going to drive equity sellers into the market in the early stages of the cash open, guys. The cash open was over here, look. There's your cash open there at 930s, and it's now trading at 880s for $1,000. Unbelievable, isn't it? How easy it is if you just get your big picture narratives. And that's a classroom we did yesterday, of course. That's a classroom we did yesterday.